but most other assets, there's not always great strategies to defer capital gains taxes. You have the installment sale when you're selling a business, but when you're selling stocks, for example, if they're not in a retirement account, really the main way to be able to do that, traditionally at least, is to be able to use tax loss harvesting, which is using capital losses to offset the gains. So that's kind of some of the frustrations there.
So Thomas, what would you say is the biggest frustration when it comes to the 1031 exchange and or just capital gains tax solutions for crypto or business exits or primary home or stock, public or private stock? What have you seen is the biggest frustration with that? And then how are you helping your clients, either defer the capital gains taxes, mitigate capital gains taxes, eliminate estate taxes? What's some of your best strategies, Thomas?
Yeah, absolutely. I think the biggest frustrations with, say, the 1031 exchange is that it's only available to real estate investors. So you can only really use it for real estate at this point. The tax laws have changed. And now, like I said, it's only available to real estate investors. So that's one frustration. Then you have very strict timelines. You have to identify typically up to 3 properties. We all know there's some nuances there within a 45-day period. And if you don't do that, then the 1031 exchange is going to fail. Likewise, if you fail to close on one or more of those properties within the 180-day window, the strict timelines that you have, it can the 1031 exchange will fail, and you'll kind of be forced to pay the capital gains tax unless you have another option, a second plan B, right? And then from there, with that can, because that tight timeline, you can be forced in some cases to make suboptimal investment decisions, or sometimes point blank bad investment decisions. So that's kind of one of the issues with 1031s. Now, for most other assets, not all, but most other assets, there's not always great strategies to defer capital gains taxes. You have the installment sale when you're selling a business, but when you're selling stocks, for example, if they're not in a retirement account, really the main way to be able to do that, traditionally at least, is to be able to use tax loss harvesting, which is using capital losses to offset the gains. So that's kind of some of the frustrations there. Now, how we've been able to help some people navigate these waters, and I'll go through the real estate side first, is, the 1031 exchange is always there. It's always an option. Then we have what's been coined, or what's become known as, rather, the lazy 1031 exchange, or 1031 exchange light, some people will call it, even though it has nothing to do with the 1031 exchange. And that's where you buy another property in the same year that you sell a property, and you use the law. You basically run a cost segregation study on it to accelerate the depreciation, use bonus depreciation to generate losses that can help offset that capital gain on the sale of the original property. Now, that works well if you're able to purchase a property within the same year and you want to continue being in real estate. That all works pretty well. However, that strategy is going to become less and less effective as bonus depreciation begins to phase down. And we're currently, as of this recording, bonus depreciation is 80% in 2023, but it's going to be dropping down to 60% in 2024, and then 20% thereafter till it's gone under current law in 2027. So there's kind of the drawback of that strategy, or how that's phasing out. Then there's always the installment sale, which can help spread out the capital gain over multiple years. That's another option some investors will use. However, you do typically have to pay the depreciation recapture tax from, if you did a cost segregation study on it or use bonus depreciation in that first year, which could be a sizable hit for some investors. Then I was throwing one or two more. There's maybe more that we could go through, but sometimes people will no longer want to invest in real estate, or want the hassles of investing in like managing properties. So what they'll do is they'll use a 1031 exchange to trade into a Delaware statutory trust. Also, basically what that is like an IRS blessed vehicle that is like a syndication, more or less, that you don't have to be responsible for the day-to-day management of property anymore. So that's an option. There's another one called the 721 exchange that we've seen some clients use, and that's where you basically contribute property to a partnership. It's usually a REIT type of partnership. And in exchange for partnership interest, for an interest in the partnership, you defer your capital gains tax when you do that. And then as you sell off bits and pieces of the partnership interests, if you do that, then you start recognizing the gain. So that's the typical ways. And there's other ways, of course, but those are the ways that like kind of overarching we've seen. And the two most popular that I've seen, honestly, have been the lazy 1031 exchange over the last few years. That's probably been the most popular, to be honest.
Okay. Got it. Awesome, Thomas. A great overview. I want to touch on a couple of these because I don't get too often people that are practitioners like yourself. And I want to do the pros and cons on this. So let's do the pros and cons. I think this would be really beneficial for people. First of all, a traditional installment sale. This is what I see, Thomas, right? Especially for business sales, right? Like you've owned this business for 5, 10, 15, 20 years. It's worth 5, 10, 15, 20, $30 million. First of all, traditional 453, you're capped at $5 million per person per year before there's an interest charge on whatever you're deferring, right? So if you're a married couple, you can get $10 million on a traditional installment sale. Then anything above that, you can still defer, but there's going to be an interest charge. All right. On the first 10 million, it's basically zero interest. But that's number one. But number two, the biggest challenge, Thomas, is everything is tied to that old buyer. All of that capital, especially if you did a huge seller carryback, is dependent on somebody who's probably not investment grade. You're not diversified. You're not liquid. You have the worst case is 2 or 3 years from now, they run the business into the ground. Now, all of a sudden, you're having to take the business back and pick up all the pieces, right? The very reason that you're selling it is probably for peace of mind that you don't want to own it or manage it anymore. Same thing to be said about the real estate, right? And so the traditional installment sale, I call it blockbuster installment sales, they're just pretty restrictive, right? That's number one. Number two, what we offer is something called a deferred sales trust, which is actually an installment sale with a third-party trust, with the third-party trustee, that's us, but you don't have to be tied to that old asset. You're not financing the old buyer, you're financing the trust. And so what we're finding is this provides opportunities for people to invest into real estate, into other business ventures, into stocks, into liquid investments, or into syndications, or into funds. In other words, you can diversify the wealth. You're not tied to that old asset, right? You have your powder dry. I mean, the 2008 crash hit, and I remember the biggest frustration with that was people had overpaid for properties, had not diversified their wealth, and found themselves owing, if they sold too much tax, right? And part of it because they had overpaid for these 1031 exchanges too often. And so we learned about the deferred sales trust, and we said, wow, this, if properly structured, and if you understand how to make this thing an investment, not an expense, how to have the controls in place to be able to be an entrepreneur, you can unlock a lot of the freedoms that us as real estate investors wanted.